Hey everyone, welcome back to Corporate Decoder. Today, Source Corp just filed their 6-month financial report, and I found some interesting trends to dive into. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing solid growth in some areas, but also facing some interesting challenges in others. Let's kick off by looking at the company's overall financial health as of the 30th of June 2026. Total assets have grown to over $9.2 billion, up about 2.3% from the end of last year. Loans and leases, which are the core business for a bank, are up to reaching over $7.2 billion. Interestingly, the renewable energy and construction equipment loan portfolios are showing significant growth, indicating a strategic focus there. On the flip side, auto and light truck loans have decreased a bit. Shareholders' equity, essentially the owner's stake in the company, has increased to about $1.35 billion. This is a positive sign showing the company is building value for its owners. However, the accumulated other comprehensive loss, which reflects unrealized losses on investments, has grown mainly due to interest rate changes. This means the value of some of their investments has gone down on paper, though it doesn't necessarily mean they've sold them at a loss. Now let's talk about how much money the company is making. For the 3 months ending the 30th of June 2026, net income available to common shareholders was about $47.5 million. That is a nice jump from around $37.3 million in the same period last year. Diluted earnings per share also went up, showing that each share is becoming more valuable. Looking at the first 6 months of the year, net income available to common shareholders was even stronger at $87.5 million, up from about $74.8 million last year. A big driver of this profit growth is net interest income, which is the difference between the interest the bank earns on loans and investments and the interest it pays out on deposits and borrowings. This is up significantly, showing the bank is managing its interest margins well. The net interest margin, a key metric for banks, improved to 4.24% for the 6-month period compared to 3.95% last year. This suggests the bank is earning more on its assets relative to its liabilities. The provision for credit losses, which is money set aside for potential loan defaults, has decreased. For the 6-month period, it was about $8.8 million compared to almost $11 million last year. This is generally good news, suggesting the bank expects fewer defaults. However, it is worth noting that net charge-offs, which are actual bad debts, have increased more this year compared to last year. Let's look at income from sources other than loans and interest. Trust and wealth advisory fees are a significant contributor, and they've seen a nice increase driven by some larger estate administration fees. However, mortgage banking income has seen a dip, and equipment rental income has also decreased. This might point to a slowdown in those specific business areas. On the expense side, salaries and employee benefits are up, likely due to normal pay increases and higher benefit costs. Occupancy costs have also risen, possibly due to seasonal weather impacting expenses. Professional fees are notably higher, which could mean the company is investing more in legal or consulting services. Now, let's talk about non-performing assets, which are basically loans that are not being paid back. These assets have decreased slightly to about $73.1 million. While this is a good trend, it is important to note that non-accrual loans, especially in the auto and light truck portfolio, have increased before being addressed. We also see an increase in repossessed assets, particularly in the aircraft portfolio. This often means that the bank had to take back collateral because the borrower couldn't make their payments. When it comes to fair value measurements, the company uses a 3-level system. Most of their assets are in level 2, meaning their values are based on observable market data. However, there are some level 3 assets, particularly in state and political subdivision securities, where values are based on less observable inputs. The company is actively managing these and reviewing their valuations. For loans where repayment relies heavily on the collateral, the company is valuing that collateral carefully. The discounts applied to reflect market conditions, and the difficulty of selling can be quite significant, especially for construction equipment and commercial loans. The company is involved with several variable interest entities, mainly for things like affordable housing, community development, and renewable energy projects. These investments often provide tax benefits. They've also consolidated some of these entities, meaning their financials are included in the company's reports, which is a common practice for banks looking to support community initiatives. Looking at earnings per share, Both basic and diluted earnings per common share show a healthy increase for the periods ending June 2026 compared to 2025. This reflects the overall growth in profitability we've seen. Delving deeper into expenses, salaries and employee benefits are up, which is typical with growth, but also due to higher incentive compensation and benefit costs. The fully taxable equivalent net interest margin shows a strong improvement, suggesting the bank is becoming more efficient in how it manages its income from lending and investments relative to its costs. Despite the overall positive trend in credit loss provisions, it is worth noting that net charge-offs have increased, while the bank's allowance for loan losses remains robust at over 2.3% of outstanding loans. The increase in charge-offs signals some potential headwinds. The overall percentage of non-performing assets to loans and leases has slightly decreased, but the core issue of non-accrual loans in certain portfolios like auto and light truck is something to keep an eye on. On the income side, while trust and wealth advisory fees are growing, mortgage banking and equipment rental income have declined. This highlights the importance of diversification and where some business lines might be facing pressure. The provision for credit losses for the quarter was influenced by loan growth and maintained forecast adjustments. The company highlights risks like geopolitical uncertainty and volatile energy prices impacting their borrowers. Now, looking at First Source Corporation's latest filing, the bank is showing profitable growth, especially in its net interest income and key fee generating areas like trust and wealth advisory. The improvement in their net interest margin is a definite positive. However, an increase in net charge-offs coupled with specific portfolio challenges in areas like auto and light truck loans suggests a cautious outlook. The company is actively managing its risks, but the economic headwinds like geopolitical uncertainty and volatile energy prices are noteworthy. What I am actually looking for next is how they manage the increase in repossessed assets and if those provision for credit losses hold steady despite the rise in charge-offs. Alright, that is my take on First Source Corporation's latest filing. What is your perspective on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. If you want the broker and charting tools I mentioned, they are in the description, affiliate links that support the channel. That is my take. Stay decoded.